Now, joining me to discuss the first trading session on the Nigerian Stock Exchange for today, as well as the expectations for both the equities and fixed income markets for the year, is Jolomi Ogundaro, an investment analyst with AfriInvest Securities Limited. Great to have you and Happy New Year to you. Now, activities on the Nigerian Stock Exchange have started the year much the same way 2018 ended, as the market declined for the second trading day of 2019. Can you take us through the performance of the market today?
Okay, so, I mean, the bearish sentiment that characterized the second half of 2018 is still with us. And so that's what we saw in the market today. I mean, today the market came down further by 1% to bring the year-to-date performance to negative 2.1%. And I mean, that tells quite a story. I mean, that's quite a significant drop over a two-day period. I mean, today we had 13 gainers and 23 losers to bring the market breadth to 0.6 times, which again is signal to the sentiment in the market. Beyond that, I mean, it's just the way the market is at the moment. The bearish sentiment in the market it's outweighing any positivity at all.
So who were the gainers and losers?
Okay, on the losers, I mean, the market, like I said, is dominated by the losers. And on the losing side, we had GlaxoSmithKline dropping by 10%, UPL by 9.6%, First Alumni dropping by 8.5%, FCMB by another 8%, and Diamond Bank by around 7%. I mean, the sheen is sort of off the Diamond Bank track, but at this point, I mean, it's had gained quite a significant amount after the announcement of the business consolidation with Access. Business consolidation with Access, and so now what we're seeing on that Diamond Bank is profit taking on that. And on the gainer side, we had FO doing 9.6%, UBN doing 8%, TransExpress doing about 8% approximately as well, and J-Burger doing about 5.2%.
All right. So, does the trend in banking sector of stock losses speak to some issue in the banking sector?
I mean, no. If you look at the banking sector performance as at the 9M, what you see is that it's actually quite a fair performance. Obviously, relative to the previous year, it's not as strong. Gross earnings growth of about 4%, bottom line growth, PBT growth about 16%. So the banking sector is solid, but what you find is that the market capitalization of the banking sector by market cap is about 28% of the market cap. So in a bearish market, when stocks are losing, it's only normal that a good amount of them will be banking stocks. I mean, today of the top 15 decliners, there were 8 banking stocks. So, I mean, it's just because of obviously the size of the banking sector and the liquidity of banking sector stocks. So when market is bearish, you would tend to see losses in the banking sector. So there's nothing to be worried about.
So what about on the gainers list? Which sectors and stocks featured?
So, I mean, we discussed this a little earlier. I mean, FO, UBN, it's still very, very shallow, to be honest. I mean, there aren't a lot of gainers in the market at the moment, and that's telling to the bearishness of the market.
All right, then, what do you expect from the rest of the week's trading?
I mean, we've sort of settled into a pattern at the moment. You have losses stacking on losses, and you get to a point where stock prices become attractive again, and then you start to see some bargain hunting in the market. But for now, I mean, this is the first trading week, and tomorrow marks the third trading day. We see nothing that's going to drive the market upwards right now. I mean, next week, maybe we might see pockets of bargain hunting, but we don't see anything to drive the market up at the moment.
So what's your outlook for the market in 2019? Is there any respite in sight?
There is a respite in sight. The most significant factor that's affecting the market now is the policy risk, which goes towards political risk and also policy risk. And this is all expected to abate with the end of the elections. We have the elections coming up in presidential elections, conclusion of all the elections in March, by the 2nd of March. And that is that's, in our opinion, would be a significant driver of the market, because part of the reason why the market isn't performing well is because the foreign participation in the market is low. the upcoming political risk. So with that dissipating, we expect to see far more foreign participation. Foreign participation begets domestic participation because it drives market performance when that much funds inflow comes into equity. On the other side, we're looking at macroeconomic stability. We're seeing stable enough oil prices as well as increased production levels with the, coming online of about another 200,000 barrels. So that we expect to see a good level of macroeconomic stability. We're seeing growth for 2019 at about 2.1%. I mean, it's weaker than we've seen in the past, but it's a good level of growth looking at where we are now. And so we look at that, and we also look at new listings coming online. You have MTN hopefully finally coming to market next year. I also see other listings coming out. All of these things come together to drive participation in the market, drive interest in the market, and we're seeing more positivity after the Q1 period, like I said, after the elections have ended.
All right, then, moving on to the fixed income market. So what do you expect from the market this new year?
The market right now is actually, it depends on where you're looking at it from. I mean, it's quite attractive for investors. The yields on bonds have gone up about 1.4%, went up about 1.4% in 2018. Right now, we're looking at an average of about 16%. On treasury bills as well, the yields are quite attractive at about 17.6%. And so, all of the reason for the increase in the yields is partly has been explained by some of the factors that affected the equity. Like I said, policy causes capital flow reversals, which causes the yields to spike as you sell down in the market. But you also add to that policy normalization in the UK and the US. So they've been increasing interest rates, which slims the differential and obviously tempers inflows into the market, even if you may not adduce it directly to reversals, since we've said reversals are mostly policy related. And so what we expect is, on the policy normalization front, we expect the US Fed not to hike as many times as they had expected. So we're expecting about 2 hikes from the US Fed. Then if you look at the UK BOE, with Brexit coming up and the uncertainty surrounding that, they may need to have more loose monetary policy, which means that there isn't so much of a threat from there. And with the dissipation of our risks, we might start to see a balance. And so we expect yields to remain around this level for most of the first half of the year, then begin to gradually trend downwards. That's not to say we don't expect volatility. This is going to be quite a volatile year. I mean, the unbundling of the US Fed balance sheet is going to have an impact on the markets. The EU ending its bond purchase program is going to have an impact on capital inflows. And then you also have, we might be having a new CBN governor this year, and the policy changes that might follow that.
Right.
All of these things bring volatility, but on the whole, we expect yields to be high and trend downwards in the second half of the year.
All right, then. Thank you so much, Jolomi Ogundaro, an investment analyst from Afrinvest Security Limited. It was great to have you on the show.
Thank you.